All right, what's going on, guys? Today is a new YouTube video and we're going over a guide to understanding futures. So remember, it's futures. Today we're talking about futures. Okay, let's get right into it. So we're going to first go over a quick definition of what futures actually are. So futures are contracts, first and foremost, where we can buy or we can sell an underlying asset at a future date, aka the name futures, right? So this underlying asset, we're going to go down here, can be gold, crude oil, or financial instruments like indices and currencies. Every futures contract has an asset that you buy at a future date, but usually we don't hold until that future date, right? The date is known as the contract expiration date, and we don't hold because it takes too long. We like to get in the market for short-term changes in prices for quicker profits. Nothing wrong with that. So let's move on. So the benefits of futures versus CFDs, which is what most prop firms have, and CFDs, I can say Forex as well, is that there's very high liquidity within futures. Futures are traded on an exchange as one central exchange. There's not 500 or a lot of different brokers because CFDs depend on liquidity providers to fill orders. So when you want to take a trade as a CFD trader, you have to depend on this liquidity provider to have enough liquidity, first of all, just to fill your order. Then let's say you want to stop out at a certain price, and this is all short-term market changes, you have to depend on your liquidity provider. Versus futures are traded on the exchange, you get the fill right away. It's more centralized and more standardized. Since these future contracts have expiration dates and prices centralized, right? Allowing different prices, right? Right here. Every single person has access to the same price chart. There's no different price charts. This increases the liquidity, making it better for everyone, and the actual accuracy of price action. And this tends to lead to cleaner price action and cleaner delivery of price. So the price action is cleaner and you can take better trades. Something important is futures are highly regulated and there's no spread. So the high regulation leads to no spread. Why, you may ask? This is due to the higher liquidity and strong regulations that the futures have compared to CFDs, where in CFDs, price is manipulated way easier, meaning you lose money more often within CFDs. Another reason, so these are all the main reasons, but we also have another reason, which why futures are better, is that taking partials. So CFDs, you have high leverage and you have to trade small sizes to risk proportionately with the high leverage. This means you close partials of a position and it makes it harder. Whereas in futures, you have to close at least one full contract, meaning you're only trading one contract, or like in sizes of a full contract. You won't get caught up closing 0.35 of a mini lot, You don't do that. You close one contract at a time. So you can buy 5 and then sell 4 to leave 1 running, okay? This makes risk management easier within futures. Futures risk management is easier, which makes trading for you simpler. There are some technical differences. Lots versus contracts. So in CFDs, using the lots is the most common terminology. This position can be small, such as a micro lot, which is 0.01 of a mini lot, a standard lot. So what you get is in futures, we always buy sell contracts in the full. So 1, 2, 3, right? And the smallest amount is always one contract. We do have mini or micro, making it easier to position your size based on your risk ability. So in futures, instead of being able to buy parts of one contract, as with lots, right? Remember, coming back to that 0.01, a new instrument is created, right? So if we're talking about NASDAQ, which is the one that I trade, we have NQ, which is the normal, the E-mini NASDAQ, right? The mini right here. And we have MNQ, the micro E-mini NASDAQ. So MNQ is the cheapest, and it is 1/10 of a full NQ contract. This is very important to understand. Now, how do these contracts and the price actually move? That is with within here, pips, pipettes, and points and ticks. So with CFDs, pips and pipettes are used, while in futures, it's points and ticks. So these are relatively equivalent, right? So we have the P and the ticks. So points, pips versus ticks. Relatively the same. So 1 pip is 10 pipettes, but in futures, we don't use any of this, right? So you can cross this out. Forget about this if you're moving over. Ticks have different sizes depending on the contract at hand, right? So as I'm guessing, most people will be NQ traders here. Therefore, 1 point is 4 ticks. Keep this in mind and let's get going. So back here, we're going to talk about the futures equivalents and CFDs so that you guys can find them better on the chart. So NASDAQ's equivalent in CFDs, we all know, is NAS 100. NAS 100 is NQ. S&P 500 is SP 500, also known as ES. Crude oil is CL. CL is also known as CL, so these are the same. Gold is XAA USD, also known as GC, right? Gold contract. Silver is XAG USD, also known as SL. So now we have to move on to here. So within futures, the contracts are changing. Remember up at the very beginning, we talked about the fact that these have a contract expiration date. And I told you to keep that in your mind for the future, okay? So now we're going to go back down to that contract expiration date and dive more in depth, okay? So futures contracts usually have 4 months of delivery. So a new contract expires every 3 months. And the expiration date, a letter is assigned to the name alongside the year so you can find it easier. So here we have the months and the letters. So January through March, the letter is going to be H. March through June, the letter is going to be M. June through September, the letter is going to be U. September through December, it's going to be Z, and we start it right up again the next year. So here is an example, because I know for some it's going to be a little bit confusing. So applying all of this knowledge into how to find them on the chart. So if we're using NQ, which is the abbreviation for NASDAQ in December, right? So we're in this month frame, we use Z. So we already know it's NQ and Z, and it's 2024. So then we use the last 2 letters. So NQZ24. That's how we find it on the chart, and that's how you can trade it. The reason why we use months of delivery instead of just the normal contract, which is going to be NQ1 and then a little abbreviation right there, is because these have better liquidity for you guys. You guys are going to be able to fill your orders quicker, less spread, and you're going to have cleaner price delivery. So now when you're trading, you have to know tick size and tick value, okay? So in trading, a tick is the minimum price increment that a futures contract will move, okay? We can see that the futures contracts have different tick sizes, remember, as we were talking about up here. Futures contracts have different sizes. So in ES and NQ, 0.25 is the increment in which 1 tick is, and that's how price will move, meaning that 1 point requires 4 ticks, while in YM, also known as Dow Jones, I didn't put it up here just because it's not as popular, but it is something good to understand. 1 tick is 1 point. So depending on the futures contract, you can have 1-to-1 ratio for points to ticks, or you can have a 1-to-4 or higher. It depends on what you are trading. Depends on what contract you're trading, okay? So the tick value, which is what we're understanding, is the change in the value of one's contract in price when the underlying assets move 1 tick, okay? So if NQ moves 1 tick, right, from 19015, 0.75 to 19016 flat, that means you made a profit of $5 because price has moved 1 tick. This also means that 1 tick is $5. So if you let it move 1 whole point from 1015.75 to 1016, then you have made $20. This is easy to understand. And remember that if you're trading minis and micros, then you take all your profits and you divide it by 10, okay? So now we're going to get into minis versus micros. So right here, the difference between the E-minis versus the micros, the E-mini versus the E-micro, is that micro contracts are 10 times cheaper. So the tick value is 10 times less in micros, which allows for better risk management in small accounts. So it is very important that if you are learning how to trade, you trade micros and you work your way up to minis. This allows you to have better risk management, and especially during these high volatility moments, because futures are more volatile, more liquidity, more volatility, you're able to manage your risk due to better stop placement and better risk portfolio. So this helps with you. So important, use micros when you're starting, then you can move on to minis and you can size up. So start from 1 to 5 or 10 micros, and then you can move on to 1 to 10 minis, which are the big boy numbers. So now we're going to move on to how to trade. So first off, we're going to go with prop firms, right? So how to trade. There's always personal funds, and then there is prop firms, two different. So let's start off with personal funds. With personal funds, you have to use your own money that you've earned, hard-earned money. You need to fulfill the margin requirements within your account from the exchanges in order to keep your money. That's a con, because you are putting your own money at risk. A pro here is that you keep 100% of the profits. A con, again, you're risking your own hard-earned money. Another con is your account size is limited by your own capital, meaning you can only make as much as you have because there's no leverage. We don't use leverage within futures trading. A pro here is that you have more control over your capital. There's not as many rules that are controlling what you're doing. So these are personal funds. I would recommend not using personal funds, first using prop firms, and then over time, as you make payouts from your prop firms, you can use it in your personal funds. So now let's go over to prop firms, where you'll understand the rest of the video. So in prop firms, you buy a challenge and you say it's 10% you have to gain, and then you can get a $50,000 account to trade with. You get that 10%, you have the 50%, 50,000 to trade with. You pay only the cost of getting funded. So it could be a $50 account, and that's the only thing you pay. This means there's less personal risk, you save money, and this also means there's a smaller barrier of entry. More people can trade. Although you may not be trading on the live market, the data is from the live market. So profit split is according to the firms and their rules. Usually it's 80 to 90% you keep, and they keep 10% to 20%. There's potential for big capital under management. So you can stack up, what I've seen people do is they stack up 10, 100K accounts, meaning you have total of 1 million under management. Prop firms, this is a con right here, is that prop firms have rules that you have to follow if you want to remain funded and get payouts, which is what you do while you're funded. So these rules can range from anything to consistency rules to drawdown rules, and they aim for them to make money. The thing with prop firms you have to understand is that their goal is not to pay you out. Their goal is to make money. Just with any business, they want to make money. So they make money off of you failing the challenge. So what I recommend is paper trade until you are ready to trade on the prop firm. And so that is the video about futures, and I hope you guys got some sort of value out of this and are able to learn more about futures and get started. If I had to recommend one prop firm to everybody, I would recommend Top Step. It's the easiest prop firm to get started with. It's simple and cheap, right? So a 50K account with Top Step is $50. You pay $50 and you trade 50K, and then you can get funded 50K, which you can then get payouts from. And you have a 90, 10 split. So you get 90%, they keep 10%. And this is really good, and I recommend everybody go and do that once you study more. So this is the guide to understanding futures, and you can go into my other YouTube videos to get more strategy for how to trade futures. Thank you very much, and come again.